Hello, and thanks for joining us for Max Financial Services Market Thursdays. Once again, brand new year and yet another exciting week. Up a lot, down a lot. You really don't know what to do. So that's what we're here for. So to start out as usual, we're going to do a weekly recap. So today we had a pretty decent day in the market. We were up about 2.2%. Once again, though, you got to put it into light. And yesterday we were down 3.2% or so. So from last week, so including Friday and up through today, the Dow was down 135 points, finishing the day at 16,379. The S&P 500 is down to 1921.83, which is down 21.26 points, or about 1% down for the week. Oil dropped $2.10, finishing at $31.16, which is a 6.31% drop, which is freaking huge. Gold was down $31 an ounce, finishing at $1,077.39. Silver finished down 45 cents at $13.86, which is down about 3% for both gold and silver. The VIX is the indicator trying to calculate the volatility in the market, finished pretty much flat from last week at 24.27, which is still at a pretty elevated level. One of the things that we typically watch is the mortgage rates. I'm sorry, not the mortgage rates, the Treasury rates, which a lot of loans, such as the mortgages, are based off of. The 10-year bond was down to 2.09% from 2.15% last week. And the 30-year bond was down another 5 basis points, down to 2.89%, down from 2.93%. So what's the significance? Simply put, I mean, so far the markets are down right around 6% for the year, which only in a matter of 2 weeks is a pretty significant amount. It's one of the worst starts of the year since 1929. Now, if you paid attention to what we've been saying over the last couple of months, this was to be expected. Perhaps I expected it to come a little bit later, perhaps a little bit towards the middle of the year or the second quarter, because typically the first couple of weeks and months of the year, you have a lot of funds that go in and they try to deploy the money in order to start making the numbers look a little bit better. But considering that we did not really have the window dressing for the end of 2015, this was not really surprising to some degree. Simply put, I mean, we're still down, pretty bad time for the market. And I think, honestly, it's just the beginning of things to come. Make sure that you watch our blab that we did about a week ago for the 12 predictions for 2016. You can also read the article that we put together in Seeking Alpha that kind of goes over the same thing. But keep an eye on that. And I'll also include a link to that article in this video. And if you're watching it on YouTube, there'll be a link on YouTube, and the same thing from our webpage. So on the economic side, we had a couple of things that we picked out for this week to discuss. The first was the EIA petroleum numbers. It's a weekly measure. We're coming up with numbers to take a look at how much crude, gasoline, and distillates we have in inventory, and both of those were up sharply. Basically, what it signals is we have an oversupply of oil, we have an oversupply of gasoline, everything that we need. Typically, the way it works is you have the suppliers, they're going to be supplying, putting it on the market. Sometimes they'll actually put it into storage if they don't want to sell it, if they think that the prices are low. So the fact that we're near all-time lows on oil, well, lows over the last 10 years or so, plus the fact that we still have such high inventory numbers, basically signals that we'll probably have more downside pressure on commodities. Basically, it's going to be good news for filling up your gas tank, or if you're a company who's looking for manufacturing. However, if you're an energy company, this is just basically the start. The second number that basically came out today that we're looking at are the jobless claims. So the jobless claims for the week were 284,000 new jobless claims, which was pretty much in range of between the 270,000 and 310,000 that people were expecting. It is 7,000 higher than the week prior. Now, keep in mind that these jobless claims numbers, they are lagging. So they're about a week and a half, 2 weeks behind. So these are the numbers through January 2nd. One thing to keep in mind is if you're an employer and you're going to let people go, you're going to wait till the beginning of the year. It's very bad karma to let somebody go during Christmas week, for instance. Continuing claims were also up 29,000 claims. Which are basically people who are continuing claiming unemployment benefits because they couldn't still find a job. So once again, because these are lagging, we expected the jobless claim numbers to pick up quite a bit, considering as companies are going to be laying people off that they're going to be laying off anyway, plus the seasonal jobs that are ending. A couple to keep in mind, I mean, Macy's put a plan in place to close 40 more stores or so, which was going to be another 1,500 jobs. So things like that are going to be happening. So keep that in mind. On the earnings side, one of the numbers that came out, I put it on LinkedIn and I put it on Twitter that kind of caught off guard some people. GoPro. So GoPro reported Q4 revenue numbers of 435 million, which is below guidance of 500 to 550 million, and it was below the Wall Street consensus of $511.9 million. Basically, they're blaming it on weaker than expected sell-through at retail stores for the first half of Q4. Anybody who's been paying attention to this, GoPro was one of those stocks that was completely hyped up. Everybody got to have a GoPro, pretty much they've hit market saturation. The problem particularly for GoPro is when they came out with an IPO, they try to price themselves as a media company because, well, all these people who are creating videos, you're going to put it on your own GoPro channel. So as such, GoPro should be valued not like a company who manufactures cameras, but they should be valued as a company, as a media company, which basically carries much higher earnings multiples. That basically didn't happen. So people are getting caught off guard. The stock is at all-time low. It dropped another 15 or 20% or so. So people are quite a rude awakening in there. Once again, though, we wouldn't touch that stock with a 10-foot pole. Personally, I did buy some GoPro when it came out on IPO, which was, I think, like 24 or so. Sold it at 48 when it doubled. And now we're back down to about $12 a share. So it happens. One of the other stocks that was really hurt by it was Ambarella, who makes the chips for the GoPro cameras. I mean, that's one of those stocks that was also like very, very hot stock. It was always very low, shot up to $120 a share. Now it's down to 40 or so, probably a little bit lower. We don't really follow it that much. On the other earnings front, Alcoa, they're the bellwether really for the economy. They reported better than expected Q4 earnings. However, they did report an 18% drop in revenues from a year ago based on significantly lower aluminum prices. So there's more activity. However, we're not making as much money because aluminum is selling for significantly lower prices. It's going to be interesting to basically see what's going to happen with that company, but people are watching it. At least what we do know and what we can gather from it is if you're a producer, if you're a manufacturer of anything, your input prices between lower commodity prices, lower aluminum prices, they're going to be lower. So the question is that going to be basically passed on to consumers, or are companies going to retain higher margins? Overall, what we do know is pretty much most of the companies they're reporting, they're not beating estimates. And throughout the entire time, what they have been doing is lowering those expectations. So one of our predictions was that we're going to have lower earnings growth, and we've basically been seeing that left and right everywhere. On the global macroeconomic front, One of the things everybody's been talking about till ears fall off is China, China, China. One of the things that was one of the articles I was reading particularly about China, and I'll also include a link, was from Bloomberg, looking at wage growth in China. The wage growth in China is the lowest that's been in over a decade, probably going back even to 2001. There's more layoffs. There's a lot more protests that are happening in China over that. Particularly, really what's been happening is China has been transitioning from a export manufacturer to we're trying to reestablish their economy kind of to a service, where the rising middle class is going to be buying up the stuff that they're producing in the country. That's China. In Germany, there's really significant pressure on Germany and also the European Union after the refugee crisis. So one of the articles I was reading was talking about the unwillingness of the refugees to integrate into the German economy and how much more money they're basically spending on trying to control the crisis basically from happening. The other thing that's really been happening in Europe is a lot of the countries have been closing borders, not only to migrants, but also just basically to people traveling. Once again, people are worried about security, and all of this is really going against really what the European Union was supposed to be about. One big economy, open borders, free trade. Now basically companies are kind of going back and re-examining that. Countries are going back and re-examining it. And really the people of Europe are basically sick and tired of it. What we're here to watch is how that transitions and if there's going to be an impact on the European earnings and growth and so forth. So that's pretty much on the bigger picture stuff. Hopefully that was a pretty good recap for you from what's been happening over the last week. Key takeaways, make sure you read our 2016 predictions. Pretty much all of them are right. Hopefully, well, for my own sake, I hope the predictions are right for the end of the year. However, if they are right, it's going to be a pretty gloomy time in the United States, if all of them do come to pan out. Other thing to keep in mind is just basically take this time, get conservative. There is significantly more downside risk than upside potential. So it's as good a time as any, particularly when the market rebounds a little bit. To basically just examine your portfolio, take a look at, is there time to lock in some of the gains that you've had over the last 5, 6, 7 years? Nothing wrong with basically keeping your money in cash until you figure out what you want to do. And evaluate your plans. It's as good a time as any to get together with a financial professional, really to take a look and focus on the risk management strategy in your portfolio. And we'll be able to help you out with that. We'll be more than happy to help you out with that. As always, thank you very much. If there's going to be any questions, we're going to open it up. We'll include a couple of links and write-ups in the comment section. And hopefully we'll see you next week. So thank you very much for joining. Take care.